And so it's pretty simple. It's a simple construct, but I feel like in the last, I don't know, 15, 20 years, maybe it's even been longer than that, it has turned almost that venture capital was something in the past. You got it when you had to, in the sense that, for example, capital intensive businesses or businesses in winner take all or winner take most markets, or businesses where that you had to achieve a critical mass, like a platform business or a marketplace or something like that, a social network. And so you took venture because you could not build those businesses just with the strength of your own bootstrapping.
Thank you for joining us again today, Heidi. It is indeed a pleasure to host you on Startup Garage. I think it's been more than a couple of years since we spoke last on the podcast.
Yeah.
Yeah. And in the last episode, I think we spoke about your journey, your time in the VC world as a founder first, and then in the VC world. We spoke a lot about culture and networking. But I thought this episode is going to be slightly different because we have spoken a lot about that. So usually I do these two kinds of episodes. One are more sort of anecdotal stories. The other are more sectoral. But I thought, let me try and do some other format. And over the last few months, I have been following the Startup Solution, which is your podcast, where you have been talking about a lot of very specific nuances. And I think that's something super interesting because most business podcasts that I usually listen to, very few of them actually dive as deep as you have into the nitty-gritties of what it is to be a founder, right?
Yeah.
So you have been talking a lot about a range of topics around startups, deals, managing boards, performance, and we want to decipher some of those aha moments today. So I thought this will sort of become an episode packed with those solid insights for founders who are looking for those specific answers. And so the first topic that I want to talk about is valuations. Now, I know there's a lot of literature, a lot of podcasts. You have spoken a lot about it, a lot of talks and about valuation techniques and how a lot of startups are overvalued and then down rounds and all of that. But particularly, I want to talk about a more systemic thing which is running in the ecosystem and how businesses were built back in the 90s and early 2000s versus how they're built now. And the founders' sort of vision and their perception of building for valuation and the whole VC ecosystem building around that and sort of supporting that. So this is something more fundamental. So it'll be great to learn from you.
Sure. And actually, it's funny because I was just working on an episode of the podcast about how to think about venture capital and how to think about should you even take money and why take money. And that's sort of the core point. I mean, valuations aside, 99% of startups in America don't take venture capital, more than 99%, right? And so it is a very rare, it is an instrument that is only good for certain things. And the way I would talk about it in the big general sense is you sell your equity for money when you can use that money to create leverage and build your business much more successfully than you could without it. It only makes sense to take money for your equity if you're going to do that other thing, right? If you're going to build a lot more enterprise value than what you gave up in your equity dilution. And so it's pretty simple. It's a simple construct, but I feel like in the last, I don't know, 15, 20 years, maybe it's even been longer than that, it has turned almost that venture capital was something in the past. You got it when you had to, in the sense that, for example, capital intensive businesses or businesses in winner take all or winner take most markets, or businesses where that you had to achieve a critical mass, like a platform business or a marketplace or something like that, a social network. And so you took venture because you could not build those businesses just with the strength of your own bootstrapping. And I think that somewhere along the way we changed, and I don't know, that's just because I'm sitting in Silicon Valley where we're marinated in this whole idea, but it seems like the first thing entrepreneurs do nowadays when they come up with an idea is they go raise money. And that's not necessarily healthy. I mean, it's kind of funny for me to say that as a venture capitalist. I want to invest in companies, but I only want to invest in companies where it makes sense that they're raising capital to use that capital to leverage the value. And that's not always the case. And so I do worry a little bit about entrepreneurs who think that the only way you start a company is you go raise capital. There are other ways to start companies. And I think that, again, over time, valuation is one element of what, changes your dilution. It changes how much you're going to end up with. But the terms have a dramatic impact. And again, I've done a podcast on why terms matter more than valuation. It's called The Case of the Downer Round, because it talks about when you have a down round, should you try to orchestrate some sort of structure that allows you to maintain a headline price, or should you just take the down round? And spoiler alert, the answer is just take the down round. It's better for you in almost any exit scenario. But my point being that as you take venture, you should be taking it to accomplish something, not just taking it because it's how people do startups. And I just don't think that's a very healthy thing to do, because obviously, in the end of the day, because of the way venture works, and you're usually selling preferred equity to get that venture, you're going to owe all that money back before you ever see a penny of whatever outcome you generate. Again, there's nothing wrong with that. That's the way this works. It's okay. There's a whole, $146 billion went into venture backing startups in 2023. So obviously a lot of people are choosing to go this route. There's nothing wrong with it, but it only works for certain kinds of companies.
Yeah, that's interesting. Also because I think the shift in mentality, the shift in the mindset of the founders who are starting new businesses, and like you said, the first step in any founder's mind when they're starting a new business is, how do I raise the next round? And I think that mindset causes a lot of different sorts of things, some positive, some negative. And you have spoken a lot about that as well. So I'm going to get to that. But before that, just taking one step ahead, you spoke about down rounds and how they're not so bad after all, right? Mm-hmm. In a world where everyone is trying to hit above their weight, there is also this constant battle that founders have with themselves. And I'm saying this with my own experience, because this happened with us when we first raised. So our first round was with angels, and then the second round, which was happening just a few months later, we were getting a much better valuation. And then this one angel comes up to me and says, you have practically achieved nothing in the last 2-3 months. So how are you getting better valuations? And I was 21 years old at that time. So I had no answer to that. But now I realize the importance of that, because what we were essentially trying to go after was just a higher valuation, instead of really trying to justify that with the business that we were in, right? So if in brief you can explain, how should founders really look at down rounds? Because practically speaking, it's really tough to accept a down round and go ahead with that. So how do you suggest founders?
Well, I mean, the first point is, even a down round is good news, because it means somebody is willing to give you more money to bet on your company. So there is nothing embarrassing about a down round. A lower valuation reflects market realities. It is a combination of whatever your performance was and whatever the market performance was. And so, for example, in the last couple of years, there's been a lot of compression of public valuations, for example, for enterprise SaaS, right? And so if you're an enterprise SaaS company, and it used to be that you could sell for 12 times revenue, and now you can only sell for 5 times revenue, it's not your fault. Even if your revenue went up, your valuation is going to go down. It's not your fault. So I think that the pragmatic thing an entrepreneur should look at is simply, do I need this money? If I take this money because it's a down round, I'm going to take a little more dilution, because the valuation impacts how much dilution you take, and then move on. And I think the mistake entrepreneurs make is a VC once told me, valuation's like the grade at the top of the paper. It's all you focus on, and the reality is, valuation is only one component of how ultimately how it impacts your exit. And so I think that the deal with the devil that entrepreneurs tend to make, because they don't like to think about valuation, because it hurts it's like it hurts their ego, it hurts their feelings, it's complicated, you have to go back and endure some pain, you have to tell your employees that you just raised money at a lower valuation, your 409A will go down, which makes you feel bad, even though that's actually kind of a good thing. So anyway, long story short, entrepreneurs want to avoid that headline number. And so they'll trade terms. They'll come in and say, well, what if I guarantee you a 2x on your a 2x liquidation preference instead of 1? Or what if I give you a guaranteed annual tick up on it? Or, there's all sorts of ways you can go to a VC and say, I would like you to give me a higher valuation. And the VC says, okay, well, then I want more downside protection. So give me a multiple, give me a guaranteed annual return, give me something. And that's usually just not a good trade-off. So I think that what entrepreneurs have to do every time they take dilution, every time they raise capital, every time they give shares in warrants to a business development thing, every time they hire an employee, they have to think to themselves, I am lessening my ownership in order to increase the value of the shares I do own. I will remain. And is this a good trade-off? And so I think, with a down round, for example, you just have to run the math. You just have to sit down with an Excel spreadsheet and you have to say, let's run the math at, my exit valuations, and don't just pick super big numbers that are that are shoot for the stars. Pick the reasonable set of outcomes that you might generate, and just look at, just run the math and look at how the terms impact what you ultimately get. Because at the end of the day, you're better off taking a down round than you are taking an up round with structure. If you know that, you just bite the bullet and move on. So I just think entrepreneurs should be less emotional about it and more pragmatic.
Yeah. That makes a lot of sense. And also, I think the one thing that all of the whole ecosystem and the pressure on the founder to raise constant capital at a higher and higher valuation, one thing that it does is it creates immense amount of pressure to succeed, at least on paper, right?
Yes.
And that often, and you have spoken about this, and hence I'm picking this up. It often leads them to, like you said, embellish the truth.
Yes.
And you have shared some insights on how very well-meaning founders they engage in fraudulent activities. In your experience, what are some of the subtle signs that an entrepreneur might be starting to cross the line from sort of embellishment to fraud? And
well, it's a slippery slope, and like you said, I did a podcast on this called I think it was the case of the not the felonious founder, but the something like that, the fraudulent founder. Case of
the fraudulent founder. Yes.
And look, I don't believe any entrepreneur sets out to be a criminal. I think entrepreneurs set out to build companies and solve problems. I think they get very involved in their companies. I think their identity gets wrapped up in their companies. And I think that they even altruistically believe that if they, embellish their numbers, but it allows them to raise money so they can keep the company going and deliver a successful outcome, that's justifiable. And so I think some of the signs of this behavior, and it's slippery slope. It starts with kind of, oh, well, let's not send that report to the VC because it's not very good, or let's only put certain statistics in our pitch deck and not the ones that don't look good. And it starts with kind of just, let's present the best light. Let's forget about this stuff, until sometimes people cross the chasm into, let's report fake numbers. Let's report a customer who's not really a customer. Let's have somebody take a reference call who's not really a customer. Again, in service, almost all the time, in service to keep the company going, right? Not in service to actually take money from investors and put it in their pocket. It's to keep companies going. But that's not okay. It's not okay. So I think one of the first signs is when you see entrepreneurs sort of not telling you when things are wrong. The second sign is really holding a tight rein on who gets to see the financial information and when. And often, you know, one of the warning signs is you'll see CFO turnover. You'll see that the people responsible for the finances, because the founder or the CEO will be saying, yeah, don't do that, or yeah, don't tell them I did this, or yeah, just pay that bill and don't say anything about it, or don't pay that bill. And they get uncomfortable. And so, you know, when you generally, it's interesting that when you look back on companies that have ended up in dumpster fires, usually they've had a number of CFO turnovers in the last, you know, 18 months before the explosion. So, you know, every case is sort of different, but I would say every one of them stems from this, what feels even like an altruistic goal, right? I want to keep my company going. But I think most people know, like I would say, hey, if you were talking to the New York Times and they said, let's write an article about how you raised your last round and what you had to do to raise it, and you actually told them, would you feel good about that being in the article? And if the answer is no, well, you know, maybe you shouldn't be doing it.
Yeah. But I think also there's a very thin line between optimism and deceit, especially when you want to present that compelling vision to the investors. And without crossing that territory, that deceptive territory, right? So in your opinion, and this is not just because I mean, of course, the founders want to keep their companies alive, but also they see that the more charming founders, the ones who can really create that charm around their vision, and oftentimes we know that vision and those numbers are slightly exaggerated. We see a lot of VCs do get charmed by it, right? So I mean, it has worked in the past.
Well, I mean, we're separating
founders.
two things. One is, yes, you want to paint a big picture. I mean, again, VC is only designed for the companies that are going to be, you know, big total markets, big outcomes, market leaders. That's kind of how the VC market works, because we're a high risk, high reward type thing. And so, yes, we want entrepreneurs to be aspirational. We want entrepreneurs to go after things for which, if everything goes well, something really big results. And so I think we always expect that, I'm going to use the words aspirational. It's not going to be that they're lying. It's just they're saying, let's put the best spin on this possible. It's one thing to be aspirational about your future numbers. It's another thing to be subversive about your past numbers, right? I mean, coming up with projections in the future that you don't end up hitting because they were a little bit too grand. And I mean, I think this is why it's so important for both you and the VCs who talk to you to understand what were the assumptions that underlie your business model, right? Though, you know, again, if I look at your numbers and they look like, you know, everything is amazing, I want to say, well, what were your assumptions? How big is this market? What percentage are you going to get? What are your cost of goods? What are your supply chain costs? What are your costs to acquire a customer? Why do you have those numbers? What led you to believe those were the right numbers? And if those numbers turn out to be wrong, which ones are going to be really impactful and which ones are not going to be impactful? So much of this is just about, when you get in the weeds with a VC, the good ones are going to poke on your business model. And it's okay if you were aspirational. I expect people to be aspirational, but don't lie about the numbers you've already generated. Don't lie about who your customers are. Don't lie about contracts that you don't have that you say you have. Those are the things that I think are going to raise the red flags. And to your second point about charisma, right? About the entrepreneurs who can talk a big game. I mean, I have very mixed feelings on this, because on the one hand, I think, well, we shouldn't be so just blindsided by the people who can tell a good story. On the other hand, those are kind of the people who end up bringing others along with them, motivating other people to come with them, motivating customers to buy from an unknown company. You know, there is an actual correlation between venture backing and narcissism, according to, I think the Harvard Business Review did something, you know, called like, you know, do narcissists make great entrepreneurs? And there is this idea that an element of narcissism is really believing in yourself and your ability to be special. And we want to back people who can be special, right? I mean, so there is
Of course.
that. I think some of that is over. I think you have to ask yourself, am I just buying into the person's personality and it doesn't matter to the company they're trying to build, or is an element of their ability as a CEO going to be dependent on their storytelling ability, their ability to get up in front of a crowd and motivate people? That may be part of how companies become successful. So I don't think you should just not pay any attention to it. But I think you should understand the role that the personality of the founder is going to play in that company's ability to be successful, and take that into account.
That makes a lot of sense. I think also there have been a lot of instances, like you said, I too have a lot of mixed feelings because we've read just way too many stories about charismatic founders going horribly wrong. I think I was reading this list of people who have been featured on Forbes 30 under 30, and I think there was a list of people who have just been on the list because of their charisma, and now they're down the drain. So yeah, I think moving on to the next topic. I think this is one topic that we can speak about the whole podcast, but I have other things that I want to discuss with you. So the next one is the startup founder advisor relationship that I do want to talk about. I think you've mentioned that a lot of founders, they rely on, and especially the first time founders, they rely on credible startup advisors on a lot of different things. And when I started up, I was 21 and barely knew anything about the world. So advisors have played a big role in what we could achieve. So if you could share an example of where a lack of clear sort of definition of what an advisor is supposed to do, how does that sort of create significant challenges for startups? Because you've spoken about how important it is to define a relationship with the advisor, especially if you're a first-time founder, and how certain situations can really lead to complex relationships and sort of strained relationships with those advisors. So how do you suggest a founder approach this sort of arrangement with advisors? And the second part is, how do you solve for if you have started an engagement with an advisor and you have not clearly defined the sort of contours of it?
So I have strong opinions about this. I don't think this should be hard. I think advisors have played a key role in the entrepreneurial ecosystem, and they will continue to forever. I think it's one of the incredible strengths about Silicon Valley, whether you think of that as a geography or just a state of mind, in that you have a lot of people who have been through something and want to help others. And so there's a lot of talent available to entrepreneurs in the form of advisors. But the mistake that gets made, excuse me, and I've done the advisor role, and I did it a number of times before I became a VC, and then in between once in a while. And the problem is the entrepreneur will say, I'm going to give you the worst one, right? The worst one is the entrepreneur says, oh my God, I know how much people respect you. I just want to put you on my slides. Like, you don't have to do anything. I'm going to put you on the slides as an advisor because I just love, your brand halo, right? I won't ask you to do much. You don't have to take calls or anything. So nice person says, what the hell, okay, sure, fine, do that. And then they call you a week later and they say, hey, could you introduce me to so-and-so at such and such a place? Or, hey, I need to raise money. You know a lot of VCs. Could you introduce me to these 5 VCs? Or, like in my case, I go way back in the industry. I know people like Bill Gates very well, and people, oh, can you be an advisor? And then as soon as you say, okay, they're like, oh, could you please send this to Bill Gates? And you know, to me, it's the, wait a minute, there's a bit of a bait and switch here, right? Because you said you
Yeah.
were going to do one thing with me and now you're going to do another thing. And I think for all advisors, there's sort of multiple levels of kind of exposure in the advisor relationship. If you think about it from the advisor's perspective, there's one is, I'm going to let you use my brain, right? But that's all I'm going to do. You're going to use my brain. You're going to ask me questions. I'm going to give you answers. It's going to help you with your business, but I'm not involved in your company. Nobody knows I'm involved in your company. You're tapping into my brain, and that's all you're doing. And then the next one is, I'm going to use your brand, right? I'm going to put your name on the website. You're going to put my name on the website. People are going to call me for reference calls. I'm going to have to say you guys are good guys or girls or whoever you are. Or, you know, I'm going to put my reputation, I'm going to tie it to yours. That's worth more money,
Yep.
right?
Yep.
And then the
Yep.
third one is, I'm going to use my network to help you, right? Networks are very valuable. They're very hard won. You cannot, you know, you cannot, even if you're Bill Gates's best friend, you cannot send every deal every day to Bill Gates, right? It is
Absolutely.
not, it is going to drive Bill crazy, or, you know, and so networks are valuable resources that are not infinite. And people like me who have worked their whole lives to build a great network that they value, and they value and respect the other people at the other side of each of these transactions. I'm not going to use my network just because somebody has me as an advisor. And so I think those are kind of, as you think about it, as if you're an entrepreneur, that's what to think about is, do I want their brain? Do I want their brand? Or do I want their connections? And each one of those has an increasing amount that you probably have to pay to do that. And I think, again, the most important thing to do when you're talking to an advisor is be really clear up front. This is what I want from you. Because if you're not, and then all of a sudden, you know, you bring on an advisor and all of a sudden a month later you say, would you please go raise money for me? Which is not at all what the advisor agreed to do. It makes them uncomfortable. They don't want to do it. Then people are just worse off at the end of this. So I just think, like most
Yeah.
things in life, it's clear upfront communication about expectations is really, really important. And then problem solving. If things go, you know, if things go off the rails, right? If on the entrepreneur's side, they keep asking for things that are not things the advisor feels comfortable doing. And the flip side is, on the advisor side, if the entrepreneur, you know, if the entrepreneur feels like I'm not getting anything out of them, they don't return my calls, they don't do things, they're not responsive, you should be able to end things too.
Right. 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 That makes a lot of sense. Also, Heidi, you've spoken about, since you spoke about the three kinds of relationships and for founders to understand what kind of relationship they want with an advisor, another important topic is compensation for advisors. And that can vary a lot, right?
Yeah.
How do you establish that fair agreement and of course, it starts with what you just mentioned, which is setting the right kind of expectations and sticking with them, right?
Yeah.
But say you've arrived at that. So when you're determining an advisor's compensation, what should be the factors that you consider beyond equity or cash? How can non-monetary incentives be structured? And especially when you're aligning with the advisor's interest and the long-term goals that your company has, because especially in the Middle East and in India, because that's the ecosystem that I follow more closely. We are seeing there is a massive trend of bringing on board celebrity advisors, which is the brand component
Yeah.
that you spoke
Like
about.
FTX did.
So, like, yeah, absolutely. So that's one way to engage with advisors. But from a long-term perspective, how do you structure their compensation? How do you structure a fair agreement where the advisor and the startup are sort of fairly managed?
I mean, you know, the challenge in doing this is, I mean, first of all, if you just were going to pay them cash, there's a cash rate. You know, I think for everyone, if you just say, I just want to pay you cash, I don't want you to own my equity, what's the cash rate? That's important to know, right? That's the market for that person. You know, if IBM came to them and said, we want you to do something for us, they'd probably just pay them cash. So what would that cost?
Yeah.
And you know, most people know what their market rate is. They know if some big company called them and said, would you consult to us? What's your day rate? Well, startups usually can't afford that. And so they want to pay in equity. And the point about equity is it's risky. And for me as the advisor, there's usually a better than 50-50 chance that that equity is never worth anything. The second point is that equity is not worth anything today. That equity is going to be worth something 5 or 7 years down the road. So it's illiquid. So it's risky and it's illiquid. So I want to be compensated for that, right? I want to make a trade. So the trade is, how much equity do you have to give an advisor before they say, all right, I'm fine making no money because I think this is going to be worth something, down the line. So I'll just give you a super weird number because it's worked for me for 25 years or more, is I just take my day rate, I multiply by 4. Don't ask me why 4. I don't know. 4 seems like a good number. I multiply by 4 and I say, because it's risky and because I can't cash this for a while, you have to give me 4 times as much equity value as you would have if you just paid me cash. And then the interesting thing is 3/4 of the time that will end up being worth nothing to me. And 1/4 of the time, it'll usually end up being worth 4 or 5 times what anybody thought it would be. Now, is that fair to the entrepreneur that I ended up making so much money off of them when it works? No, not really. Because as I said, we're in a high risk, high reward entity.
Absolutely.
It's just like venture capital. It's a little bit when you're an advisor and you're giving yourself to a startup, you are making an equity investment, right? You are, it's just that instead of giving them money, you're giving them cycles of yourself. And so I don't know,
your own time.
That's a number that works. And again, at the end of the day, if somebody balks and says, well, that's too much, then you can always just say, well, then just pay a cash day rate, just pay them cash. Don't keep them around for a long time. The other thing is, I think, right sizing the term of the deal to what when you expect the value to be given is also important. I mean, I think a lot of times people are like, we want to be an advisor and I'm going to put you on a 4-year contract. I mean, very few people add the same amount of value across a 4-year period. Usually advisors are very dependent on the stage your company is at. So I would say 6 months, a year, maybe 2 years at the outset. But bringing on advisors and giving them long contracts, I don't know why anyone does that.
Yeah. That makes a lot of sense. Great. I think one more sort of connected stakeholder in the ecosystem are strategic investors. And I think they also provide, apart from the capital, they provide a lot of other things that traditional VCs don't. And corporate venture capital is on a boom. A lot of new innovation departments in Fortune 500s want to now invest in startups. And I think also because, also there is a lot of times some conflict that the startup presents to their traditional businesses. So the startup might have the capability to disrupt the business of that firm, but they still go ahead and invest in those founders because they believe that technology can really sort of take their businesses to the next level. And so in that process, they add a lot more to the founder, to the business, than traditional VCs. So what are your thoughts on strategic investors versus traditional VCs? Because some founders that I have met with in the recent past have very strong opinions about not raising any capital from traditional VCs and only looking at strategic investors.
Right.
What are like
and
the
some
pros
feel
and
the
cons?
other way. They only want pure
some
VC.
feel the
Don't want. So I mean, I think just to clarify, because I think it's a really fundamental distinction, right? And by the way, I love co-investing with strategic investors, the right ones to do the right things. But fundamentally, when you take VC money, the only way a VC makes money is if your stock goes up in value. But when you take strategic money, the strategic money, if your stock goes up in value, that's great. But if their stock goes up in value because they did a deal with you, that's even better. That's why they're called strategic investors. Strategy is the first reason they invest in you, not just to make money. So it's very different, right? A venture investor is 100% aligned with you because they only make money when your stock goes up.
Yeah.
And so with a strategic investor, I don't think they're bad. I think they're great. They often have access to channels you don't have. They have knowledge you don't have. They have, that. And by the way, your example of companies that invest in disruptive things. I mean, I think it's fascinating that some of the biggest oil companies in the world, their venture groups are investing in renewable energy. I mean, it's because
Yeah.
they
Yeah.
understand they are energy
Yeah.
infrastructure companies, and they understand that eventually they have to move off of oil. And so they have a lot they can bring to the table. But having said that, if they optimize for themselves over your startup, that can create complexity, right? And conflict down the line. And then the other thing is more subtle. And it's actually a podcast I have coming out in a couple of weeks, is
Oh.
about guilt by association. The idea
Mhm.
of what happens if you take, for example, and in fact, the case is in this episode is about somebody who took money from an oil company and is doing a renewable thing and is now being accused by an activist of having sort of greenwashed this oil company, right? Which again, really true story, just not disclosing who it happened to. But
Mhm.
it is that is something you have to think about as an entrepreneur is the source of your capital. Are there real problems? Are there real challenges with the source of your capital? Like they want to write a first refusal, or they want exclusive license to your product for so many years, or they want something in addition to money for equity. They want an
Mhm.
advantage from you. Again, nothing wrong with negotiating those deals. Just make sure you're actually getting the value out of it that your side of the equation is offering. So
Yeah.
you do
Yeah.
something like that, it's not necessarily a problem, but for example, a right of first refusal might kill your chances of being acquired by anybody. I mean, is that
Yeah.
worth doing? I don't think so. So I think you just need to be careful. Like anything, you need to understand the terms, you need to be careful. And then I think
Mhm.
the reputational risk, you just have to recognize that if you take money from certain entities, you may find that members of your constituency, maybe it's your employees, maybe it's your customers, maybe it's just the community you operate in, might have a problem with that. And you have to decide, do I care or not? And again, I'm not telling you you should or shouldn't care. I think everyone
Mhm.
has to make their own decisions, but I just hope that they will be thoughtful up front about what might the potential collateral damage be if I were to take money from this particular entity.
Hmm. That makes a lot of sense. I feel like a mix of traditional VC and strategic investors makes a lot of sense. But you also mentioned that there are people who would rather stay away from strategic investors.
Mm-hmm.
Why would, I mean, apart from the downsides that you just explained, is there anything else that, in your experience, founders point out to as a disadvantage of raising money from strategic investors?
I mean, usually when someone doesn't want to raise from strategics or someone doesn't want to raise from VC, it's because they had a bad experience. And the bad
Hmm.
experience can be, maybe there was turnover at the strategic firm and they lost their
Mm-hmm.
champion, and then it was just mired in, a lot of them get mired
Hmm.
in bureaucracy and paperwork, leadership
Yeah.
changes, and they decide to de-emphasize something that was important to them before, and they
Yeah.
stop
Yeah. Yeah.
investing money in it. You're a mouse and you're dancing with an elephant, and sometimes the elephant steps on you. And so sometimes people say, well, I don't want to work with strategics because they were a pain in the ass about this, or they wanted information rights, and then one of their departments, took my information and used it to compete with me, or, whatever it is. Stuff
Yeah.
does happen on occasion. I think the vast majority of strategic investors are great and on the up and up and do things well. I think there's a whole professional industry around strategic investors, and I have great
Yeah.
respect for them in their industry. There are some
Mm-hmm.
bad actors, just like with venture. There are
Yeah.
venture, in bad times, and venture optimize for themselves, or they pull an extra, onerous term right at the wrong moment, or they say they're going to fund and then they don't. Or, I mean, again, it's not like strategics have a lock on bad behavior. There's plenty of bad behavior to go around for
Yeah.
everybody else too.
Yeah. Yeah.
And so I think sometimes people have those experiences and say, I'm not signing up for that again.
Right. 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 So that makes a lot of sense. Of course. I mean, if you just happen to be stuck with a bad strategic investor, there's equal likelihood of being stuck with a bad VC. So
yeah, I mean, that's why reputation is so important. That's why when you're raising money, you need to do diligence on the person who's going to give you the money. I mean,
mhm.
people say to me, yeah, if I had the luxury to choose from multiple sources, I
I
get
was
it.
going to say that.
Like sometimes you'll get one term sheet and
Yeah,
that's what you have and it's take it or not. I get that.
yeah,
But I think you should
yeah.
just as we diligence the entrepreneurs, right? Have they gotten in trouble in the past? Have they lied or
Mhm.
cheated, or they've done ethical transgressions that we might not want to have? What is their reputation with their prior coworkers or co-founders? Those are important things. They're indicators of how they're going to do this time around. And I think
Yeah,
you're an entrepreneur and you're going to take money from someone, you should talk to people who've taken money from them before, and not just the successful ones, right? And ask the investor, can you please put me in touch with an entrepreneur where the outcome wasn't good? Because
yeah.
my partner Emily says this. She's like, we make our money on the good deals. We build our reputation on the sideways ones, on the ones that it didn't work out,
Yeah,
but we did the right thing. And so
yeah,
again, I just think every entrepreneur, when you're out raising money, I think for some entrepreneurs, they look at VCs as like, we're like an ogre sitting on a bridge, and right behind us there's a burlap sack full of money. And you say the magic words to the ogre and they step aside and you can go across the bridge and get the money. And then you never have to talk to them again. Right. And that is not at all what
yeah,
we are, or at least what we think we are. We actually think
yeah.
that we're your partners and we're going to provide capital, but we're also going to help you build that company. And some of
Mhm.
us do a better job of that than others. And some entrepreneurs want that help. And some other entrepreneurs just view us as ogres and wish we would just go away. And so I don't know how to solve for that. And I expect some people in my industry are in fact ogres. So,
Yeah.
I think that again, just entrepreneur beware, that you need to do diligence. You need to understand how this person is going to behave, because particularly if you're seed stage or even you're probably going to deal with that person for the next 5 to 7 years. So you better
Yeah,
make sure
yeah.
that you feel good about getting in a trench with them, because that's where you're going to be for 5 to 7 years.
No, absolutely, absolutely. And I mean, this is something that's very close to my heart. I think I did a presentation back in my MBA. So I actually did my MBA right after I exited my second company, and
Uh-huh.
they asked me to do like a presentation on my learnings from running a business.
Mm-hmm.
And this was top of my list, and because this is a mistake that I have committed personally, and I still feel this was the biggest mistake that I committed. And no amount of I can't stress this enough as a founder how important it is to do your diligence,
Yep.
especially at the C and A level.
Yep.
And I mean, if you need any kind of supporting content on this, feel free to let me know. I can,
Well, sounds like
I
we
can.
are of like mind about this.
Yeah, yeah, absolutely, absolutely. Great. Um, so Heidi, you also spoke about in the middle. You spoke about networking, and that network is a big asset that you have built over your lifetime.
Mm-hmm.
Um, and it is essential for founders as well. So balancing it with the demands of their actual work can be really challenging because and you have addressed this, that this is a hard reality. And how do founders really balance effective networking, which is actually beneficial for them, versus the actual hours that they need to put in their venture? So how do you suggest
Now,
they go
I mean,
about?
again, there's no perfect answer, and every
Yeah.
entrepreneurial company is different. Every business is different, but I would generally say
Hmm.
almost all businesses, tech businesses in
Hmm.
particular, they don't stand alone. They ride in ecosystems. They ride in the ecosystem of the operating system. They ride in the ecosystem of the network, of the hardware provider, of the the vertical, they're not vertically integrated, so they rely on people above the stack and below the stack. They are in an ecosystem. And pretty much, at least till the AI overlords take over in a few years, people run those ecosystems. And so understanding people and doing, at the end of the day, people do business with people. And and people are messy, right? And so to me, the idea of an entrepreneur, networking isn't just about, I'm going to get something from you today, right? Networking to me, I don't even like the word networking because it sort of implies that you're kind of monkey barring your way from one, getting something from someone, getting something from someone else. I view it in a very different way. I view it as leading a relationship-driven life. And in a relationship-driven life, I recognize that the relationship with anybody is more important than whatever individual transaction I'm doing. Anybody, right? Even if I'm getting in an Uber, I should respect the Uber driver as a human being. I should treat him or her with compassion and be friendly and do my part of the job of being a good customer. And because, first of all, it's just good humanity to do that. Second of all, hey, they rate me just like I rate them, right? You get enough bad ratings on Airbnb and you can't get a rental anymore. I mean, it's a two-way street here, and I think that's been enhanced by the way technology works and the way marketplaces work and the way digital reputation works. So I just think that for an entrepreneur, you have very limited time. You need to focus on what's important. But it turns out people are important, right? The most important people, your co-founders, your key employees, your key vendors, your key distribution partner, whoever they are people. And even, and also like journalists, for example, understanding, and anytime you want to build a relationship with another person, you need to understand, what is their motivation? How are they judged? How do they, why do they do what they do? And I think it's very important to understand that about anybody you do business with. I think it's a mistake that entrepreneurs make, even with VCs. Like, I had an entrepreneur once raised a lot of money. And I once said to him, do you even know where VC money comes from? And he said, yeah, it's rich people play money. I said, it is 100% not rich people play money. It is teachers unions and university endowments and bus driver unions. And they didn't give us the money and say, go gamble and have fun. They gave us the money and said, we expect, this doubled or tripled in the next 7 years. And that's our job. And so understanding what we as a VC, what we're supposed to do is important before you take VC money. Because then, don't be surprised when we have to do something that we determine is in the best interest of the company, even if that's not in your personal best interest, because that's our job. That's what we signed up to do. That's what our limited partners who gave us the money expect us to do. And so I just think it's important in every relationship you form, having an understanding and therefore empathy for the other side of the equation is going to make you a better partner. And I believe that being better partners results in better, well, first of all, it just makes you happier. This is nicer to be this way as a person. But I think it also results in better business decisions and better business relationships. And I can tell you, I'm 66, so I've been doing this for a very long time. And so I run into people that I've have people I work with today that I have worked with for 40 or more years. Right. Wow. And I didn't intend, the first time I did a deal with them, I didn't say, hey, I hope you're going to be around for the next 45 years because I'd like to keep working with you. It just happens. I mean, ecosystems, and again, tech, Silicon Valley, big place. Can't tell you how many times I run into people, right? I can't tell you how many times, you give me any startup name, I'll look at their board of directors, I'll know somebody, right? It's just because this is what I've been doing my adult life. I'm born and raised here. This is what I've been doing my whole life. And so you do run into the same people over and over and over again. And it really helps if you have a good reputation with those people. And it really helps
Yeah.
you to know which ones should you be dealing with, which ones are going to hold up their end of the deal, and which ones are going to be respectful, and which ones are not going to cheat or lie to you, versus the
Hmm.
ones that you've done business with and you say, you know what, I don't want to do business with that person anymore because I don't trust that person.
Yeah.
And you know who to avoid, right? So it's super important, super important.
I'm sure. Yeah. I'm sure that's super important for you. Now that, I mean, you have built this vast um, sort of network of people, and you have built relationships with people over the last 4 years, like you said. I'm sure it's really hard for you to really try and sort of prioritize your time and say, I'm sure you say no a lot of times, right?
Oh, you
So,
have to say, you have to
uh,
prioritize your time. You have to think about what's important. You have to say
mhm,
no. But the flip side is you also have to make yourself open to new opportunity. And so
hmm,
sometimes you have to engage in things or participate in things when you don't know exactly what the payoff's going to be. And then there's
hmm,
also giving back. I mean, I think for a lot of us, and certainly at people my age, part of why you do things is not what's in it for me. Part of why you do it is because you want to see the next generation be successful. You want to see people apply ethics to how they start and build and grow and you know, create these massive
hmm,
companies that are going to change the world. You want to make sure that they're being thoughtful about the
yeah,
responsibility of doing that the right way, and how that benefits the world. And so I think there's all sorts of complexities about how we each think about what we do, but at the end of the day, I think the
yeah,
foundation of ethics, and I think
mhm,
also the idea that your reputation is the most important asset you have. And you can
yeah,
blow it so easily. Like no transaction is worth blowing your reputation.
absolutely, absolutely. I totally agree with that. Heidi, you've built your relationships in a period where there was a massive transition that was happening. Simply, if you take access to information, and how you would be connecting with people back in the 90s and early 2000s, now it's massively different, right?
Mm-hmm. Mm-hmm.
Everyone is connected to each other all the time. um,
Mm-hmm.
in I mean, and you have seen that transition in the workplace and in your professional relationships as
Yeah.
well. um, what would your sort of suggestion be? And I'm asking this for myself and for people like me. What would your suggestion be? Because we often hear that building relationships, and like you said, it doesn't have to be something that I need today, but it has to be a consistent, genuine effort to connect with other people and try and understand their motivation and how you can probably add value to their lives, right? So what would your sort of practical wisdom nuggets be for young people who are bombarded with a lot of information?
Yeah.
Two, there is a lot of noise out there,
Oh yeah.
and if they can if they can if they can really add value to somebody's life, there are probably 100 other people who can do the same thing for that one person that they want to build a relationship with, right? So in a world that's now very, very different and very noisy, what would your advice be to the 25-year-olds and the 30-year-olds?
Well, I think it's really hard. I mean, I think every single thing you do is documented and, you know, whatever, and can be brought back. I'm sure glad that all that stuff I did when I was 25 is not sitting out on social media somewhere. So, you know,
Yeah.
so my first comment is just don't just fall in the trap of using social media because everyone else does. Again, I did a
Mhm.
podcast on, it's called the Social Media Meltdown, and it's about how what is my approach to social media, because I think
Mhm.
people just get comfortable putting everything out there, commenting on everything, even things they have no knowledge about, doing all that. And, you know, you're creating a record of yourself. And is it really the best reflection of you? Is it even an accurate reflection of you? I see so many people worrying so much about how many friends they have or how many likes they have. And I mean, interestingly, even some people, their whole living relies on that, right? I mean, social media influencers who, it sounds to me like a lot of them have horrible lives because that's all they do and that's all they have to think about, and they have to do it all the time. um,
Yeah.
it's not the real world. It is a component of the real world, and I think you just need to be careful. So if you look at my social media, I don't post about my personal relationships. I don't post about I don't really write a lot about my children. I don't really post about what I'm doing on my vacation or something. I put things that are important to my work up there.
Hmm.
And I'm careful because I don't want to have to live or die by some social media thing that someone else determines they're going to judge me by. So I think that's it. I think the second thing is to, again, just keep remembering we're humans first. We're humans first. We're our jobs second. We need
Hmm.
social connection. We need to be able to like and respect the people we work with. We owe
Right.
it to ourselves to have a community and to build that community. And again, I think it's really hard for startup entrepreneurs because a lot of times our startup becomes our world.
Yeah.
And it's funny, I had a meeting with some of my alums from my graduate fellowship last week, and we were brainstorming on stuff and talking about stuff. And one of the things we talked about is, there's a lot of startups who say it's a family. I'm like,
Yeah.
no, it's not a family. It's a startup. It's a for-profit entity. You will be
Yeah.
eliminated from that family if they cannot afford to pay your salary. Like it's not like my family works very different than startups work. And so don't get confused about the nature of the entity that you're
Hmm.
related to. But I think the problem is because, and I was there too. I'm guilty. I resemble this remark. That's why I can say it so unequivocally. Is when you're the startup CEO and you're working 24/7, the only people you see might be your
Yeah.
coworkers. The only people you talk
Yeah.
to might be your coworkers. So of course they become, in essence, like a family. I get it, but I
Absolutely.
just think people need to be aware of that and need to remind themselves, my startup is not my life. My startup is a really important thing I'm doing right now that I'm going to spend a lot of time on for maybe years or even decades, but it's not all of me. And
Yeah. Yeah.
and
Yeah.
that's, I think that's one of the hardest things entrepreneurs have to do.
I'm sure. I'm sure. Also, I feel like it's all the more difficult, and I have grown up in a world where smartphones were just picking up, and I have spent the first half of my life without any telephones and without email and internet, and then the second half had all these things come up. So we were that crossover generation as well, and I I sometimes I sometimes find it really hard to connect with people, especially only over um, digital connections like digital media, and um, especially for founders now that are going completely remote. It's really surprising to me how that culture is really sort of catching up
Yeah, it's
because
really hard. I think this remote only, or I mean, in a way, I love remote. I love working remote. I like that people can work
yeah.
remote. I like that they frees them to not necessarily be in a geography, especially a place like Silicon Valley, very expensive. But I think
Hmm.
there's a cultural cost there's a
Yeah.
cultural tax on not being physically together. And I think people
Yeah.
forget
Yeah.
how to be together. And I mean, we all remember when COVID first, the
Yeah.
lockdowns got lifted, we were like awkward. We didn't remember how to like eat food around people and stuff like that. It's kind of crazy how
Yeah. I know. I
I think,
know. I
again,
know.
it's just another thing to be aware of. It's another thing to try. And I know for me, my number one, when someone wants to meet with me and have a conversation about something important to them, I try to do it over a walk. And why do I do it over
Hmm.
walk? Well, first of all, even if the meeting is worthless, at least I get exercise. But but
Yeah.
the truth is, because you're more focused when you're on a walk with somebody. You're not looking at your
Hmm.
device, you're not listening to something else, you're not constantly watching for who else comes into the room or goes out of the room, or that constant partial attention that is so terrible for
Yeah.
all of us. When you take someone on a walk, if you're able to do that, it changes the dynamic of the kind of conversation that you have. And
Hmm.
I think that's just one small thing you can do. Also, because entrepreneurs are chained to their computers all the time, this gets you out of that as well.
Yeah. Yeah. I totally agree with that. Great. I think, Heidi, I think we are absolutely on spot with the time.
Great.
So,
Well, thank you. I really appreciate
thank
it. It was a great
you.
conversation, and
Great,
look
great
forward to
speaking to
talking
you
again
again.
sometime.
Absolutely, Heidi. And thank you so much. And anytime you're in this part of the world, I'm based out of Dubai now. So
Terrific.
anytime you're in this part of the world, please let me know.
I will. No
I'd be
current
really
plans, but eventually. All righty.
absolutely.
All right.
If
Take
you
care.
plan to, let me know. Take care,
Okay.
Heidi.
All right.
Take care.
Bye.
Thank you. Bye.